This just happened, and if you're trading silver today, you don't have the luxury of ignoring it. Overnight, CME Group is hiking silver margin requirements by roughly 36%, and that change goes live tonight. That's not a headline for tomorrow, that's a clock ticking right now. Spot silver's hovering around $81 to $82 an ounce, still down about 33% from last week's peak of 121.64. And leveraged traders have hours, not days, to come up with more cash or sell into thinning liquidity. Both the exchange notices and clearing brokers have confirmed it. Stay with me because I'm going to show you what this actually does to price, why the timing matters, and how you can spot this pattern before it hits next time. Before I explain what caused today's pressure, let me teach you something most people don't really internalize. Margins aren't opinions, they're plumbing. Think of the market like a highway during rush hour. Leverage is speed, margin hikes are sudden lane closures. Nothing about demand for the destination changed, but cars still slam the brakes. When margins jump, your broker requires more collateral per contract. If you've got it, fine. If you don't, you sell. Not because you want to, but because you have to. That's why these moves feel emotional even when they're mechanical. And once you understand that, you stop asking why is everyone panicking and start asking who is being forced right now. Now here's what's actually happening. Margin requirements control leverage. They're set by the exchange based on volatility, risk models, and position concentration. When markets are calm, margins are low. You can control a large position with relatively little capital. That's great when you're right. It's deadly when you're wrong or when the rules change mid-game. And that's exactly what's happening today. CME is telling everyone in the silver futures market that, as of tonight's close, you need 36% more capital to hold the same position you had yesterday. Think about that for a second. If you were running at max leverage, you now need to find tens of thousands of dollars per contract just to stay in the trade. Most retail traders don't have that sitting in cash. They're already fully deployed. So what happens? They get margin calls. Their broker gives them a few hours to wire money or reduce positions. And if they can't, the broker liquidates for them. It's automatic. It's mechanical. It's not personal. Here's why this matters so much. Silver just had one of the most violent moves in recent memory. It spiked to $121, then crashed 33% in days. That kind of whipsaw action shakes out weak hands naturally. But now you're adding a structural catalyst on top of an already fragile situation. You're forcing liquidation at a moment when confidence is already cracked and liquidity is already thin. That creates a feedback loop. Selling begets more selling. Stop losses get triggered. Market orders hit the tape. Spreads widen. Price cascades lower until it finds a level where buyers finally show up in size. And all of this happens not because someone decided silver is worthless, but because the mechanics of the system are forcing traders to exit regardless of their fundamental view. If this is making sense, drop a comment below and let me know where you're watching this from. I want to know who's paying attention to this stuff in real time. So, let me walk you through the sequence of what's actually unfolding today. First, the primary driver is the margin hike itself. A 36% increase means a leveraged long suddenly needs materially more cash by the close. Let's say you're holding 10 silver contracts. Each contract represents 5,000 ounces. At current prices around $80, that's $400,000 of exposure per contract. Before the hike, you might have needed $15,000 in margin per contract. Now, you need over $20,000. Multiply that by 10 contracts and you're looking at finding an extra $50,000 by tonight. And that's just to maintain your position. You're not even making money yet. You're just trying to survive. Second, the timing is brutal. It's hitting after a violent drop, when confidence is already fragile and liquidity is thinner than usual. Think about who's left in this trade right now. The smart money that bought at $70 or $80 and sold into $120, they're gone. They took profits. The people still holding are either unleveraged long-term bulls who can weather the storm, or leveraged speculators who got caught in the downdraft and are hoping for a bounce to get out even. That second group, they're the ones who are about to get squeezed. They don't have the capital to meet the new margin requirements. They're overleveraged, they're underwater, and now the exchange just changed the rules on them. Third, you've got secondary signals swirling around the tape. Reports about positioning at JPMorgan Chase, temporary disruptions at the London Metal Exchange, and systems issues at HSBC all became part of the narrative. Now, exchanges and banks deny coordination. And you should always be careful with that word. I'm not here to feed you conspiracy theories. But here's the convergence. Regardless of intent, the effect is the same. Leverage gets squeezed at the worst possible moment. You've got margin hikes hitting. You've got clearing issues creating uncertainty. You've got reports of concentrated short positions at major banks. Whether those things are coordinated or coincidental doesn't change what they do to trader psychology. Fear compounds. Uncertainty spreads. And when you're leveraged and facing a margin call, you don't have the luxury of waiting for clarity. You have to act. So, when the margin notice hits, selling begets more selling, stops get triggered, volatility spikes, and price hunts for where forced sellers finally exhaust. You see this pattern over and over again in markets. It's not unique to silver. It happened in oil in 2020. It happened in GameStop in 2021. It happened in crypto multiple times. The setup is always the same. Fast move attracts speculators. Leverage piles in. Volatility explodes. Exchange raises margins. Forced liquidation follows. And the people who understand that this is mechanical, not fundamental, are the ones who don't panic. But here's the part that should make you nervous if you don't respect the mechanics. This isn't about someone changing their long-term view on silver. This is about survival into the close. The trader who bought at $100 isn't selling because they suddenly think silver is going to zero. They're selling because their broker is telling them they have 2 hours to wire 50 grand or get liquidated. That's a different kind of pressure, and it creates a different kind of price action. You get capitulation candles, you get volume spikes, you get wicks on the chart that make no sense from a fundamental perspective, but make perfect sense when you understand the forced liquidation dynamic. Now, let me show you what very few people are talking about. When margins go up, they don't just affect new trades, they affect existing positions. That means everyone who's already in the trade suddenly has to post more collateral. And here's the kicker. Most of those people are already at max leverage. They used every dollar they had to get into the position in the first place. So, where do they get the extra cash? They either wire it in from somewhere else, which most retail traders can't do on a few hours' notice, or they reduce their position size. And reducing position size in a thinly traded market creates downward pressure. It's supply and demand. More sellers than buyers at the current price. Price falls until it finds equilibrium. Zoom out with me, because this is the exact same playbook we've seen before. In 2011, when silver went parabolic and margins were raised repeatedly, you got violent air pockets, chaotic closes, and then weeks of aftershocks before anything resembling a base formed. Silver hit $49 in April of that year. It was a moonshot. Everyone was calling for $100. Then CME raised margins 5 times in 8 days. 5 times. Each hike forced more liquidation. Each liquidation created more volatility. And volatility justified more margin hikes. It became a self-reinforcing cycle. By the time the dust settled, silver had dropped to $32 in a matter of weeks. That's a 35% decline, driven primarily by mechanical liquidation, not a fundamental change in supply and demand. What happened next? Silver spent months forming a base, retested those lows, and eventually found buyers again. But the traders who were over-leveraged, they got wiped out. They didn't get to participate in the eventual recovery because they got forced out at the worst possible prices. Same pattern we're seeing today. Fast move up, leverage piles in, volatility spikes, margins rise, forced liquidation follows. Then, only after the leverage is cleansed, price can start reflecting actual supply and demand again. Let me give you another example. March 2020. Remember that? Everything was falling. Stocks, bonds, commodities, even gold. Why would gold fall in a panic? It's supposed to be the safe haven, right? Well, it did fall. It dropped from $1,700 to $1,500 in a week. Not because gold suddenly became less valuable, but because leveraged funds needed to raise cash to meet margin calls and other positions. They sold what they could sell, not what they wanted to sell. Gold was liquid, so it got sold. That's forced liquidation. It's indiscriminate. It's mechanical. And it creates opportunities for people who have dry powder and understand what's happening. Every time this happens, the pattern rhymes. You get a fast move that attracts momentum traders. Leverage builds, volatility explodes. Exchanges or brokers tighten margin requirements. Forced selling begins. Price overshoots to the downside. Then, once the leverage is flushed out, price stabilizes and eventually recovers as fundamentals reassert themselves. The larger story isn't that silver is suddenly worthless. It's that the market is resetting who's allowed to stay in the trade. If you can't handle the volatility without leverage, you get kicked out. If you're underleveraged or unleveraged, you survive. That's the game. Now, let me be skeptical for a moment, because I want you to hear independent thinking, not just hype. Could this all be overblown? Could price stabilize right here at $80 to $82 and make everyone who panicked regret it? Absolutely. Markets are unpredictable. Maybe there are big buyers waiting at these levels. Maybe institutional money sees this as a gift. Maybe the margin hike was already priced in, and we don't get the cascade I'm describing. All of that is possible. And here's the thing about manipulation claims. They're emotionally satisfying, but they're rarely actionable. You can't trade intent. You can trade structure. Whether there was coordination between CME and the bullion banks, or just bad timing, doesn't change what you need to watch into the close. You can spend all day arguing about whether JPMorgan is suppressing silver, or whether this is all natural market forces. But while you're arguing, price is moving. Margin calls are hitting. Traders are making decisions. Focus on what you can control. Price levels. Volatility behavior. Whether selling pressure diminishes after the margin change actually takes effect. Could this be a buying opportunity? Maybe. If you believe in the long-term silver thesis and you've got cash on the sidelines, this could be a chance to add at lower prices. But timing is everything. If you buy too early, you catch a falling knife. If you wait for confirmation that the forced selling is over, you might miss the bottom, but you also avoid getting stopped out in the chaos. That's the trade-off. There's no free lunch. Could the fundamentals have changed? Sure. Maybe something happened in the supply and demand picture that I'm not seeing. Maybe industrial demand is collapsing. Maybe a major mine came online, but I don't see evidence of that. What I see is a mechanical event, a margin hike, creating technical pressure on an over-leveraged market. That's not fundamental. That's structural. Here's what I know. Markets don't care about fair. They care about who has capital and who needs to sell. Right now, the people who need to sell are getting squeezed. The people who have capital can wait. And the exchange just tilted the playing field even further by raising margin requirements. That's the reality. You can be mad about it, you can call it manipulation, or you can adapt to it. I choose to adapt. There are probably 3 types of people watching this right now. First, you're long and over-leveraged, and you're feeling that tightness in your chest. I get it. You bought in at $90 or $100, thinking this was going to the moon. You leveraged up because you didn't want to miss it, and now you're staring at a margin call and you don't know what to do. Here's my advice. Reduce your leverage. I know it feels like giving up. I know you don't want to take the loss. But staying in the game is more important than being right on this one trade. If you get forced out tonight at $80 and silver bounces to $90 tomorrow, you won't be there to benefit. But if you reduce your position, survive the volatility, and live to trade another day, you can re-enter when the picture clears. For you, the question isn't what silver does next year. It's whether you can survive tonight without being forced out at the worst price. Reducing leverage isn't weakness. It's staying in the game. Second, you're flat and frustrated, watching this from the sidelines. Maybe you sold too early, maybe you never got in, and now you're kicking yourself because you missed the move up, and you're watching this carnage thinking you should have known better. Here's the thing. Your edge is patience. Let the forced sellers finish. Let volatility tell you when the panic subsides. Watch for signs that the liquidation is complete. When you see volume dry up, when you see volatility contract, when you see price hold a level despite negative headlines, that's when you consider stepping in. Don't chase. Don't FOMO. Wait for your pitch. The best trades come when everyone else is exhausted. Third, you're long-term bullish and unleveraged, wondering if this invalidates your thesis. It doesn't. If you believe silver is undervalued based on supply constraints, industrial demand, or monetary debasement, none of that changed overnight. What changed is the leverage structure of the speculative market. And that's temporary. Leverage gets flushed out. Weak hands get shaken out, and eventually price finds a level that reflects real supply and demand. If you're unleveraged, you have the luxury of waiting. You don't have to do anything. Just hold and let the market sort itself out. But it should remind you that position sizing matters more than being right. Even if your long-term thesis is correct, if you're over-leveraged, you won't survive to see it play out. So here's what I want you to answer in the comments. Which camp are you in? Are you holding? Are you watching? Are you underwater? I want to hear real perspectives from people in the trenches right now. The universal principle here is simple. Markets punish impatience and reward preparation. If you're scrambling to meet a margin call, you weren't prepared. If you're sitting on cash waiting for clarity, you were. There's no judgment in that. It's just reality. The traders who make it long-term are the ones who respect volatility, who size their positions appropriately, and who don't assume the market will give them time to be right. So here's where I stand. I'm not chasing and I'm not panicking. I'm watching. Let me tell you what I'm personally watching. First, I'm watching whether $80 to $82 holds into the close, because that tells me if forced selling is slowing. If price stabilizes here despite the margin hike going live, that's a signal that most of the liquidation already happened and we might be finding a near-term bottom. If price breaks below 80 and accelerates lower, that tells me the forced selling isn't done and we could see another leg down. Second, I'm watching $70 to $75 as a potential final washout zone. If liquidation accelerates, that's where I'd expect longer-term buyers to show up in size. That's a level that would represent a 50% retracement from the recent highs, which is a common place for markets to find support after a parabolic move. If we get down there and volume spikes on the downside, but price holds, that's capitulation. That's where you start thinking about building a position. Third, I'm monitoring volatility after margins go live tonight. If volatility contracts tomorrow, if the wild swings calm down, that would tell me the mechanical pressure from the margin hike is dissipating. That's information. That tells me the market is starting to digest this and move forward. But if volatility stays elevated, if we keep getting these whipsaw moves, that tells me there's still unfinished business. There are still over-leveraged positions that need to get flushed out. Based on my analysis, this move was mechanical, not emotional. It was driven by a structural change in margin requirements hitting an over-leveraged market at the worst possible time. The fundamental picture for silver, the supply deficits, the industrial demand, the monetary uncertainty, none of that vanished overnight. What changed is the speculative structure, and that's temporary. If history rhymes and silver follows the same pattern we saw in 2011 or other commodity shakeouts, the move that follows could be significant once the leverage is cleared out. I'm not making a prediction. I'm saying the setup exists for a recovery once the forced sellers are done. But you have to survive the liquidation first. You have to have capital available when the opportunity presents itself. And you have to be patient enough to wait for confirmation rather than trying to catch the exact bottom. I'm not a financial advisor. This is not financial advice. Do your own research. Verify the data I'm giving you. Check the CME notices yourself. Talk to your broker. Understand your own risk tolerance. Don't take my word for anything. Take the framework I'm giving you and apply it to your own situation. If you made it this far, you're the kind of person who thinks critically and doesn't just react to headlines. That mentality will serve you well. Most people panic when they see a 33% drop. They sell at the bottom, they buy at the top. They let emotion drive their decisions. You're here because you want to understand the mechanics. You want to see the structure behind the price action. You want to know why things happen, not just what happened. That's the difference between surviving in markets and getting chewed up. So, do me a favor. If this breakdown helped you see what's really happening today, share this video with someone who needs to hear it. Hit the subscribe button if you want more real-time analysis like this. And drop a comment letting me know what you're watching for in silver over the next few days. I read every single one, and your perspectives make me sharper. Stay sharp out there. Think critically, verify the data, and make your own decisions.